Started here. Thank you so much, everyone, for joining us again today for our Young Scholar Seminar. I'm Mike Barnett. I'll be moderating our panel or our discussion today. This is actually our third webinar so far in the series. We previously had Thomas Swomanen and Ishan Nath. Both of them are wonderful presentations, and we're looking forward to Daniel's presentation today. The previous ones have been recorded, so you can look for those on our e-Access Forum website. And today, Daniel's going to talk about his paper, Can Finance Save the World? Measurement and Effects of Coal Divestment and Policies by Banks. Just to give a little background, Daniel's an assistant professor of business administration in the finance unit at Harvard Business School. His research focuses on corporate finance, capital markets, and financial intermediation. His current research explores the relationship between the organization of financial markets, firm capital structure, and economic activity. He studied this in a variety of studies, ranging from high-yield debt markets to microfinance. Professor Green holds a PhD in financial economics from MIT Sloan School of Management and a BA in economics and mathematics from Rochester. And prior to his doctoral studies, he worked in the capital markets group at the Federal Reserve Bank of New York. Now, before we turn the time over to Daniel, we are going to launch a poll. So there's a short survey to give a little idea about the topic we'll be discussing today. So Anushka has put that up. That should be available for everyone to answer now. If you want to just take, a quick 30 seconds or so to answer that. And then we will wait for that. And then we will get started in just a second. Okay, so it looks like we have our responses here just to kind of set the stage. First question was, could bank divestment policies affect the ability of targeted firms to access capital? About 70% of people said yes, 25% maybe, and 5% no. And could bank divestment policies affect real economic activity in the coal sector? Again, a very interesting question. About 60% think that could be true, 40% said maybe, and 0% no. So we will turn the time over to Daniel to sort of discuss these and his research. Again, you can put answers or questions you have in the Q&A throughout. We'll try and get to those as we can, but we'll have a good chunk of Q&A at the end where Daniel will be able to respond to those. So the time is yours.
Great. Thank you. Thanks, Mike, for inviting me and introducing me. Really looking forward to presenting this paper. I want to reflect on the poll a little bit. So either you guys have read the paper, or you're quite optimistic on how kind of financial interventions can affect the world. The question we're studying here is exactly this question. So it was really interesting to hear what the priors were going into it. And the motivation is, there's been a huge public interest in kind of using finance as a tool to accelerate the energy transition more broadly, this ESG movement of starting to say, well, there's things people care about besides the bottom line in society, and can we use kind of the allocation of capital or levers within capital markets to try to get companies to do things maybe other than just maximize profits. Kind of the theoretical mechanism here is if people divest, so if a bunch of people say we're not going to invest in fossil fuels, that's going to lead to a decrease in the supply of capital, which economics suggests should lead to either like rationing, so some people don't get it, or an increase in the price. And that is going to mean that firms, are unable to finance economic activity in areas that people are not interested in financing. That's kind of an interesting question, though, because theoretically we should expect, people have the ability to raise alternate sources of capital. So if some people kind of stop providing capital, maybe other people are going to step in. And we might think that in kind of public equity markets, the impact of one of these policies might be quite limited if 10% of people decide they're not going to do fossil fuel investing. The way that people hold diversified portfolios, the mechanism for that influencing the cost of capital is kind of limited. So we want to see, is there any context in which this kind of policy will work? And then further, does these financial policies actually translate into changing the way the world operates? So is there a hope kind of in the absence of a carbon tax or more direct government intervention for financial tools to kind of help society in nonprofit dimensions? Okay. And to kind of dive in on that, we're going to focus on the coal industry, both coal mining and coal-fired power plants. And the reason for focusing on that is one, because people have done it. It's been a seminal target of the banking industry. The banking industry, as I'll show you, has started to get out of investing or providing capital to the coal industry. And it also is important because if you think about the theory of why divestment policies might not work, they're less likely to work if capital is more substitutable. So where do we think capital is least substitutable? Maybe divestment in that market will have a bigger effect. And we think in the coal industry, capital is going to be hard to substitute because of the heavy relationship on bank intermediated debt. It's a heavily project finance oriented kind of operation, mining and power plant construction. And those project finance entities depend a lot on relationships between banks and the sponsors of those project finance operations. And if you lose your banking relationships, maybe as in contrast to losing an investor in your stock, it's going to be harder for you to go find a new bank to do business with, especially in an environment where kind of across the board, we're seeing a high level of interest in banks getting out of coal. And because coal is a highly capitalistic industry, finance is a quite important input, right? So you know, capital, labor, capital is very important. So increasing the cost of capital or rationing capital can have a big bite potentially on you know, real outcomes in the coal industry. Okay, so the questions we're going to try to answer today, the main ones are going to be, do bank divestment policies in the coal industry have financial and real effects on the firms they target? And what we're not going to be able to answer today is the next question, which is equally or if not more important. The most important question is, even if that's true, does this actually limit climate damage or reduce emissions or help slow down climate change? Because if not, you know, and unfortunately, I'm not going to be answering this today, but among all the people, the smart people in the room interested in this topic of saving the environment, we have to figure out which tools are actually effective. And as soon as we find out something isn't, we should all go work on something else. Okay, so let me explain broadly what we're going to do in this paper. What we're going to show you is that coal companies are differentially exposed to bank divestment policies. So there's a lot of banks out there who I'll show you have started getting out of the coal industry. And because the coal companies all have different relationships with different banks, some coal borrowers are exposed in the sense of their relationship banks are getting out of coal and other ones are less exposed and their relationship banks are not getting out of coal. So we have variation in who's exposed to bank divestment policies in terms of on the borrower side. And on the lender side, we also kind of carefully construct measures of the strength and timing of the bank bans on coal lending. So combining these two sources of variation at the firm level, your exposure to banks that get into coal divestment in the future, and at the bank level, how strong your ban is and when that ban kicks in, we can use those sources of variation to construct what's called a shift share instrument, right? Like a bar tick instrument to kind of try to instrument for a coal firm's access to or limits to their access to capital and see if they actually respond to that in terms of ability to raise capital, in terms of other financial outcomes, and in terms of operating decisions. And then one thing we're going to have to try to look at is what drives banks' decisions to adopt investment policies in the first place. It could be a reverse causality story there, so we're going to dig into that. And then we're also going to kind of a central tenet of this argument that in the coal industry, being exposed to a bank that gets out of coal is going to matter is if it's hard to substitute away from relationship banks. So that's going to be an important kind of hypothesis or necessary condition floating around in the background of this analysis. Okay, to preview the results, we are going to first measure this divestment policies of a large set of banks, and kind of the main finding is size weighted in terms of like which banks are active in the capital lending market and bond underwriting market. Size weighted, most banks have coal policies. However, there is big heterogeneity in the timing and strength of those policies. We also find that there's predictability in which banks adopt coal policies. So banks with larger coal businesses adopt fewer or less likely to adopt policies, and they're more likely to adopt them later. So there is in some sense, endogeneity of who adopts coal policies, and it kind of goes in the direction you would expect. To that extent, you might say that some of the activity in the bank space of getting out of coal can be thought of a little bit as greenwashing, because the first banks to do it were the ones that actually had the least to lose. And then finally, in terms of the effects of these policies, we're going to find actually that they're quite large and consistent with their intended effects. So we're going to see firms at the firm and bank level kind of having a larger either exposure to divestment policy at the firm level or at the bank level being a divester. We're going to see contraction in the credit these firms can obtain and the credit that banks are issuing. We're also going to see contraction on the balance sheet of the firm. So their long-term debt and size goes down. And on the real side, the thing we can show you is that being exposed to banks that get out of coal, it leads to faster plant closure or earlier retirement of coal-fired power plants. So in the absence of finding new continued capital, these firms that are just deciding to close up shop a little earlier than they might otherwise do. Okay. To give you some background, when I first came into this project, I kind of thought coal was a dying industry. And I said, well, what's the big deal of divesting from coal? It's already on its way out. So what I learned, though, is coal is declining in the US quite precipitously, but that's not true worldwide. A lot of the economic growth of the last 20 years has been powered by coal-fired power plants. Coal mining is a big input in steel, and steel is also obviously a big part of economic development. So as we've seen internationally, economic expansion, that's come with the downside of a lot more coal activity, and coal is the biggest kind of pollutant in terms of fossil fuel emissions. The most harmful one of all the options for raising power. So just kind of to get everyone on the same page, that coal is a very important input to energy production globally, much less so today in the United States, but globally it's still quite important. Second, I want to show you just a count of, in our data, the number of banks that are adopting coal divestment policies. And these policies really start to kick in around the adoption in the 2015 of the Paris Accords. That's when people really got serious about using limiting access to finance as a way to try to combat climate change. And you can see by the end of our kind of coverage, we have over 80 banks that we've kind of read and analyzed and coded up the divestment policy of those banks for. To give you some examples of divestment policies, I'm going to show you two policies, one from Wells Fargo on the left and one from Barclays on the right. And this is just to give you a sense of kind of the variation in both timing and strength of the policies. So you probably can't read exactly what these policies say, but on the Wells Fargo side, all this policy is doing is restricting the financing of mountaintop removal coal companies. And specifically, they do not directly finance mountaintop removal of coal mining projects. Okay, so they're not doing project financing for mountaintop coal removal, nor do we extend credit or facilitate capital markets transactions to coal producers engaged primarily in mountaintop removal mining. So what this ban says is we don't do project finance for a specific type of coal mining, and we don't do credit or work in capital markets with companies that most of their business is mountaintop removal. Mountaintop removal coal mining is the most environmentally egregious form. You literally like claw off a mountain to do it. But it's a very small part of coal mining activity, both in the US and in the whole world. So we view this policy as very limited. And not, you know, they get to put out a press release that says they have a mountaintop or they have a coal mining policy, but if you dig in, it's really quite limited in what it's actually preventing them from doing. In contrast, Barclays policy goes further in two dimensions. First, we can see just from these bullet points that there's a ramp up in the strength of this policy over time. So starting in 2020, they're not going to provide financing to any clients that generate more than 50% of revenue from coal activities. That's either mining or power generation. By 2025, they're going to lower that threshold so that they're no longer doing business with companies that make at least 30% of their revenue from coal. By 2030, that goes down for 10%. And they also say they are going to provide what's called transition finance for companies trying to reduce their thermal coal portfolio. Interestingly, when we went into this project, we thought language like this was kind of a carve out, right? That would be more like greenwashing to say, oh, if you provide transition finance, then you're not really serious. But in the data, we're actually finding the firms that are more exposed to banks like Barclays, which have kind of a comprehensive policy that gets stronger over time and offers the opportunity to transition. Those are the banks that are actually kind of contracting credit supply most seriously. And the firms exposed to those are the ones that are responding the most aggressively. So that's kind of just an interesting result, is that we thought this was kind of more like greenwashing, but it is, I think what we're seeing now is policies with some carve-outs for transition are actually more sincere policies than ones maybe without any of those carve-outs. Okay, so that's some background on what the divestment policies we're looking at look like. In terms of the data, we're going to start with a list of firms that are highly active in the coal space. So there's an NGO that's trying to advocate for divestment from coal companies that's assembled something called the Global Coal Exit List, which establishes a criteria for kind of how big or how coal active companies are. And if they're big or coal concentrated enough, they end up on this list. And we're just going to use that list as a starting point for gathering as much data as possible on companies in the coal sector. So we're going to match that list of companies to transaction data from IJ Global, which is a source of project financing, and DealScan, which is a source of syndicated loan financing. We're going to match to bond and equity issuance from SDC Platinum. And then we're manually collecting bank divestment policies, leveraging some work by NGOs in this space that have started with a list. We go back and look at all the banks we can find from those lists and carefully enter the details of their divestment policy. And then we're looking at financial statements from Orbis, and we have information on CO2 emissions and also plant activity in the coal-fired power sector. In terms of summary statistic, so our sample, once you merge all the data together, we get 410 out of the 935 firms appearing on the Global Coal Exit List. That covers about 66% of annual coal production worldwide and 61% of installed coal power capacity. So it's decent, but not great coverage. We're missing a lot of coverage in Asia. And there's also a lot of small companies that don't make this list in the coal-fired power capacity. So there's like municipal and local power plants that are not big corporate entities that we're able to collect data on. Okay, so now let's turn to measuring divestment policies. So what we do is we carefully read these 82 policies we've collected, and we came up with a list of kind of the most common attributes of these policies. So the policies talk about things like, are they going to ban project finance? Are they going to ban corporate finance? Does their ban depend on the coal fraction of the revenue or the coal share of power production? Does it depend on if it's a mining company or power company? Is it a new customer of the bank, or is it not a new customer? Is this a thermal use of coal, like burning the coal to generate power? Is this financing going to new construction or an expansion of an existing facility? There's some of the banks talk about mountaintop projects. And on the right side, I show you kind of the share of the banks that condition in some sense their policy on this variable. So you can see that a lot of banks are kind of discriminating on whether it's a power project or not. A lot of banks are very focused on if it's new, if you're financing the new construction of a new facility that does a new mine or a new power plant. And many fewer are kind of explicitly targeting things like new customers. So that was a surprise to us. Some of the biggest banks are only at first banning new customers, but that's not a very wide feature in the data overall. And then what we do with all those variables is we code up in terms of logic. And here you might recognize the syntax highlighting of stata. But the idea is that if you tell me something about a particular coal financing activity, the bank, the customer, the attributes, the demographics of that customer, what year and what continent that transaction happened in, I can tell you if this bank would have or would have not allowed that transaction by their own coal policy. So what this is going to allow us to do is to kind of measure in a very kind of non-parametric way the strength of coal policies, right? So we can use this detail to understand how strong a coal policy is based on how much coverage the logic of the wording of their policy actually maps into in terms of how much economic activity are they shutting the door on. Just to show you a few kind of different, they're called simulation outcomes here, but what it really is we look at a few kind of the most common scenarios, and we look at what fraction of banks are getting out of that, are banning that kind of activity at a particular point in time. And what you can see is the orange lines are related to power. So The thing that banks are most interested in doing is no longer financing project finance of new coal-fired power plants. Right? So you can see that by 2020, these bands imply 80% of the banks in our sample are no longer going to be financing new coal-fired power plants through project finance. They're much less strict on corporate finance. So corporate finance is the dotted line that hovers around 20%. So if an entity, instead of using corporate finance, goes through project finance, they'll have an easier time obtaining capital. Mining overall has lower kind of strength of bands, but they follow the same trends in terms of it being stronger bands for mines that are new versus expansion, and more emphasis on project than corporate finance. I can show you here, just looking at on the extensive margin, what fraction of banks kind of size weighted by their share of the capital market are banning coal activity by continent. So we're seeing that by mid-2020s, about 80% size weighted of European banks have some sort of coal divestment plan in place. That came in much quicker. The North American and Asian banks were slower to adopt coal policies, and fewer of them have coal policies. On the intensive margin, I can show you conditional on the bank adopting a policy, looking at a measure of the intensity of the policy. And our main measure of intensity in the talk today is what fraction of all the possible scenarios. So if you're project finance or corporate or mining or power, new customer versus existing customer, our measure of strength at the bank level is going to be what fraction of those in a given year is the bank no longer allowing. So conditional on adopting a policy, again, we see European banks are ramping up kind of the intensity of their policies faster than North American and Asian banks. And they're also a higher kind of general strength of the policies in place. Next, I want to turn to the adoption of bank policies. So what we want to understand is there some sort of predictability in which banks are adopting coal policies? And the answer is some predictability, but not much. So in the first column here, I'm going to show you in the about 1,000 different banks in our sample, we're just trying to predict, do you have a coal policy or not? And remember, there's only 82 banks we've detected have a coal policy. Many of these banks are very small and regional, and it's possible they have policies. They didn't put out a press release about it. But in the broad sample, the only predictive thing of having a policy is size. So large banks are more likely to have coal policies. That's not totally surprising. Turning to the intensive margin of once we've linked up all our data, looking at the banks that are in our lending data and have adopted coal policies, that's 74 banks. The coal share of lending is a significant predictor in column 2 of, are you early to adopt a coal policy? And also in column 4, what's the strongest your coal policy ever gets? So it is true that the larger coal is as a share of your business, the less likely you are to adopt coal policies, the less likely you are to, adopt them early, and the more likely you are to have weaker policies if you're more active in the coal lending. So there is some endogeneity that's important. It's an important result of this paper to document that it's not 100% sincere who's adopting these. Banks that are more active in the coal space have weaker and later policy adoption. Okay, next, we're going to now take kind of the adoption of coal policies as given and look at, do banks actually respond to the adoption of their own policy? And what we're showing you here is on the left-hand side, kind of the syndicated loan or project finance loan or bond underwriting. So we combine bonds and loans here because these policies are most of the time banning both of underwriting and actually direct lending. So we're going to have the log of lending at the bank year level. And I want to see, can we predict that with the presence of a policy in column 1? So banks that have adopted coal policies as a given year have on average 50% reduction in the amount of coal lending we see, which is kind of what we would expect if they actually are adopting coal policies. Of course, that number is not 100%, likely because these policies are not comprehensive. They maybe only target corporate or project finance and not corporate finance, or they phase in over time. Then in column 2, we turn to our kind of preferred measure of ban intensity. And interestingly, at the bank level, we don't kind of see this year-to-year kind of alignment with conditional on having a policy. The stronger your policy is one year to the next. Oh, and sorry, and all these have bank fixed effects. I don't know where the X's went down here. So this column 2 is within bank. And does the timing of the strength of your policy actually predict the level of your own lending? And we're not able to detect that. However, turning to column 3, kind of if you pool this more as like a pooled difference in difference and just look pre-post 2015, we can see that the strongest your coal ban ever gets predicts on average a decline in your lending, kind of even controlling for having an active policy. So here we are documenting an intensive margin, even conditional on a bank having a policy. The stronger their policy ultimately gets, the more their lending is actually contracting. We actually see the effects are strong as well for banks that have more complex policies. So the more complex the policy, we thought that initially would be a sign of greenwashing, that was a sign of carving out. But actually the more complex ones actually on average have, they do have more bank response in terms of reducing coal lending. So banks with more complex policies reduce lending more than banks with less complex policies. We also code up a measure of transition score, which I was talking about earlier, is does the policy the bank has written kind of indicate the bank is interested in sincerely phasing out coal over time? And we find those also reduce their coal lending overall more. And finally, we use an NGO Reclaim Finance's own scoring, which was a little bit less quantitative than ours. And we see that also does predict that the kind of the intensive margin of their measure predicts at the bank level, banks getting out of coal. Next, we're going to turn to the financial effects. So at the firm level, so we've documented that at the bank level, banks are sensitive to their own policies, and they do contract coal lending of kind of themselves. But now we want to see our firms at the firm level, are they going to be affected by exposure to bank divestment policies? So to kind of to get into those results, we're going to have to understand how we map from bank level divestment policies to firm level exposure to those policies. As I said before, bank divestment policy strength is going to be coded as the fraction of all the possible scenarios that could be banned that are banned in a given year by a given bank. So we're going to have this bank intensity variable, which is the fraction of banned scenarios, and that's at the bank by time level. Now turning to the firm level, the borrower level, we are going to construct their exposure to divesting banks based on their kind of pre-Paris Accords relationship lending history. So we figure out what's the share of a borrower's capital supply from each of the lenders in our data in the pre-period. And then we're going to weight the bank's subsequent divestment strength by the borrower's pre-period exposure in terms of how much business they're doing with that bank. So that's going to show you this final column here, the active ban intensity. So at any point in time, this will be 1 if 100% of a borrower's relationship lenders have the strongest possible divestment policy at a given year. And it will be 0 if none of your lenders at all have a divestment policy, or if all of your lenders do, but that divestment policy is extremely weak. So here we're combining kind of the time series and cross-sectional variation in the bank's strength of their bans with cross-sectional variation in which borrowers were more exposed based on relationships to banks that subsequently divest from coal. Okay. And then now I'll show you kind of the main results. Again, this is log debt issuance at the firm year level on the kind of as the dependent variable of these regressions. The right-hand side variables are all standardized to be a standard deviation of the band intensity strength. So we see here that having a 1 standard deviation higher exposure than in this cross-section of borrowers to a bank with a higher band intensity, to banks with on average higher band intensity, is associated with around a 16 or 17% reduction in debt issuance for the firm for a given year. So firms that are more exposed to banks with coal policy bans that are stronger are going to reduce their ability to raise capital. We can see this is concentrated in firms that have a high share of coal. So in our data, we can figure out, is this firm kind of a conglomerate, or what fraction of their revenue is derived from coal mining or coal-fired power plants? And firms with above median coal shares, that's where all these financial results are coming from. So they're not coming from firms with like conglomerate firms that might only have coal as a small part of their business. We can also see the results are all being driven, the financial results are all being driven with small firms versus large firms. Right? So firms with a small, in our data book value of assets, are the ones responding to this, and that's consistent with financial frictions, meaning affecting smaller firms more. It's harder for small firms to find new relationships or break out into to other capital markets, like raising equity or going into the corporate bond market, if they're not large. So we see all the effects are coming from smaller firms. We also see all the effects, interestingly, are coming in the mining sector. There's not financial effects. Even though I'm going to show you, we observe real effects in the power sector, we don't observe financial effects. And I'll reconcile that in a moment. Okay, I just wanted to do some robustness here and show you kind of other measures of band strength. So our measure is this active band intensity measure, which this first column here is the same as column 2 in our previous regression. We can also show you the results hold similarly for this NGO Reclaimed Finance's own measures of divestment policy and our measures of transition and complexity score. So we're not really kind of got lucky with a particular way to think about the band intensity strength. It seems like any way you look at this, firms that are exposed to banks with more serious, in some measure, policies towards getting out of coal are the firms that are kind of contracting their ability to raise capital in this credit market. Next, we want to see, is there any evidence of kind of the idea is this only works if firms are unable to substitute, right? So we want to understand kind of to what extent this reduction in aggregate borrowing at the firm level is coming from an inability to substitute. So it could be that they are kind of finding some replacement capital, and we want to look into that. And here what we're going to do is we're going to decompose the dependent variable, the left-hand side variable, the firm year issuance of debt, into whether that debt is coming from a bank with a coal policy or not, or from a relationship bank or non-relationship bank. And we can see here that all of the contraction in lending is coming from banks that with coal policies. And all of the contraction also is coming from relationship banks. And what we might expect is if firms were able to substitute into other lenders, we would see positive coefficients on non-coal policy banks or maybe non-relationship banks. So, and we don't see that at all. So we don't see that there's kind of a large reduction in lending from your existing coal policy banks or your existing relationship banks. And we do not see substitution into other banks, and we do not see kind of substitution into non-relationship banks. So that tells us the relationship lending channel here is quite important. I was not expecting this. I was expecting to see kind of negative numbers in the left column and positive numbers in the right column, but maybe the negative number would be larger, indicating you weren't able to fully replace your lost financing. We're just not seeing any evidence of substitution. We also look, although the data is quite limited, on the kind of the equity side. We look, is there any evidence that firms are going to primary or secondary equity markets to raise capital? And the big caveat here is that the sample that we're able to observe this for is quite small. So if firms are doing some sort of private investment in public equity or something, we're not measuring that here. If they're getting acquired by private equity firms, which is a popular narrative in the press, we're not capturing that here. Okay. And one big concern with the previous analysis I've shown you so far is that we are not accounting for the these results could be biased by the fact that firms might be substituting into forms of capital that we're not observing, right? So our data is primarily from bond underwriting. We observe like public bond issuance, we observe syndicated lending, and we observe project finance activity that's reported in this database IJ Global that tracks project finance. If the firms are doing lending that isn't going to show up in one of those databases, we might validly see contraction in borrowing from divesting banks, but we might be missing substitution into other banks. And that concern is a challenging one fundamentally for the paper to address, because the concern is always going to be there unless we observe every financial transaction in the world. But what we try to do to ameliorate that is look at the balance sheets of the firms in our data set. And then we can see that the stock of debt of exposed firms also decreases. And again, this is only decreasing for the small firms in our sample. And kind of what that shows you is that even if we're not measuring the transactions, the firms are still shrinking the long-term debt on their balance sheet, and they're unable to replace it. So if they were replacing it with debt from vendors or from sources we couldn't observe, it would still make its way onto the balance sheet. But the fact that we do see a reduction in their balance sheet debt shows that kind of this is not the full story. There's not perfect substitution into some unobserved portion of the capital market. I can also show you there are some effects, measurable effects on the size, but it's a little bit weaker. So firms that are more exposed do seem to get smaller. Okay. And then, so next we want to ask kind of, are firms, so to summarize, basically, firms are changing their financing policies, it looks like. The evidence so far is that bank divestment seems to be effective at limiting access to capital. The average treated firm, conditional on treatment, sees a 24% reduction in annual borrowing. I don't have a table to show you here, but I will point out that's mostly coming from the extensive margin. So conditional on a firm borrowing in a given year, we're not seeing a big difference in how much it was able to raise. All the results pretty much are coming from firms just no longer choosing to enter or being able to enter the debt market, right? And we're not seeing a measurable substitution into new bank lenders. We're not seeing substitution into equity markets. Okay. Next, I want to turn to the real effects of, does this actually matter? Like, so what if these coal firms are getting less kind of external capital? So to do this, we're going to use kind of the only data we have at the moment, which is kind of data on the operating status of coal-fired power plants. We observe kind of the near universe of coal-fired power plants, and we do our best to link those back to the firms in our study that we're able to identify as being kind of substantial coal operation firms, and that we also observe lending data for and bank relationship data for. So we're going to collect data on the plant level characteristics and, importantly, operating status in every given year of a coal-fired power plant, link that back to the owners. And then we're going to try to understand, does exposure of the parent company of this coal-fired power plant to divestment policies, does that cause any delay or acceleration of retirement of that coal-fired power plant? And the Cox proportional hazard model is kind of a great way to look at that. These coal plants on average, you know, they eventually retire. There's a strong structure in the data in terms of the plant age, plant location, plant size of predicting retirement. The Cox proportional hazard model is saying, let's model that baseline rate of retirement as a function of everything we know. And does that rate of retirement get shifted by this exposure to banks with divestment policies? So here what we can see is being exposed to a bank in general with a divestment policy. On average, it makes the banks kind of unchanged. Like, so coefficients above 1 here mean there's an acceleration of plant closure, and below 1 mean there's a delay in plant closure. But what we really see is post 2015, plants with exposure to the largest, kind of most serious bank bans significantly accelerate the retirement of those plants. So that's controlling for the age of the plant. It's controlling for the country of the plant. It's controlling for a time trend. The biggest result here is that the more exposed the owner is of that plant to the bank ban policies, the earlier that plant is going to be retired. And that we see that that is a robust result in the data, and it's not really dependent on the kind of whether it's a large firm or not. What the kind of we interpret the result to be is that kind of companies with other options that are facing coal-fired power or facing coal bans are trying to get out of these projects early. They have something better to do. And okay, yeah, okay. So let me highlight the results of this paper, and then we'll move on to the Q&A and discussion. So the motivation of this paper is broadly that there's broad interest in trying to understand how can we, or is it even possible to use changes in finance and changes in kind of the incentives of capital allocators, ESG policies or divestment policies or exclusionary policies, do policies in capital markets of trying to choke off capital to industries we think have negative social effects, do those policies work? The biggest caveat to those policies is always the question of, well, if some people do it, but not everyone, aren't these borrowers just going to go find capital from someone who doesn't care? We don't seem to find any evidence of that. We do not find substitution to other forms of capital. We do find that firms that are more exposed to banks that get into coal divestment do reduce the amount of borrowing they're doing. We find these effects are concentrated in smaller and less diversified firms. And there is, of course, more work to do on measuring the strength of these policies. Right now, I've given you a very kind of high level view, which is just the kind of fraction of potential coal funding opportunities that a given bank would ban in a year. What we're working on now is kind of more closely aligning, understanding, are banks banning things that their customers are doing or not doing? And the idea is if banks, a coal policy that's more serious is kind of more stringent on the funding of projects that its current relationship customers are actually in the business of doing. So we're trying to see if there's any evidence that banks are kind of tilting their own policies away from their own kind of borrowers composition. And if not, does accounting for that give any extra bite? But broadly, the question here is, does divestment work? We are finding some limited evidence that it does work in a place where we think it would kind of, if it doesn't work here, it's not going to work anywhere else. If it doesn't work in relationship banking, where a large number of banks are getting into the policy, it's not going to work in public equity markets. But we do find effects in the banking sector. Okay, well, I'm finished with the talk. I'm happy to hand it over to some questions. I do see one question in the Q&A. Let's see, can you talk about how the difference in impact between banks' policies on lending and underwriting versus investors' policies? Yes. Okay. Yeah. So the question is there a difference between banks' policies on lending and underwriting versus investors' policies on holding and selling equities in companies? And I think academic kind of conceptually, I think going into this paper that policies on bank lending are much more likely to have an effect than policies on equities. And the reason is there are many, many, many thousands of people who could hold a given stock. There are only so many banks that have the expertise to finance a specific type of coal-fired power plant or coal mining operation. Also, even given that there's few, even worse is that their relationships are important in that industry. It's going to be very difficult for a bank facing a dying industry to go and lend to a company that it hasn't worked with before. So for all these reasons, we think that there's going to be a stronger bite of kind of divestment in the sense of bank lending policies versus kind of equity ownership policies. Another question, any thoughts on whether large firms faced with divestment policies from banks increase their borrowing from shadow banking? That's a great question. So there's many ways to think about shadow banking. One we're looking at is non-bank lending. I don't know if that's exactly what you had in mind by non-bank by shadow bank lending. For non-bank lending, we're looking in all the publicly traded US firms in all their 10Ks in the last 15 years to look at all their debt agreements and see if they're doing any debt agreements with anyone that's not a bank or that didn't make it into our sample of lending transactions. Okay, great. That was your question. Okay. So I can share preliminary results with that is like we've spent a long time looking through the 38 US coal publicly traded coal companies, and we found only a few cases where we found a transaction that didn't show up in our data set. That doesn't mean that perfectly answers your question. That just means that in the kind of the non-bank lending of public companies, we don't seem to be seeing any substitution into that channel. How applicable are these conclusions to divestment policies relating to the oil and gas sector? So we think about this as kind of the blueprint for oil and gas in the future. Coal is a smaller industry. It's a more kind of harmful in terms of pollutants industry than oil and gas. It's a little bit less strategically important at the moment than oil and gas. So if anything, these conclusions say that it's worth pushing in terms of implementing divestment for real effect in oil and gas, but it is going to be more of an uphill battle. But I would say exactly the point of this was to start in a place where we thought this was most likely to work. And if we found no effect there, we'd say it's a real hard sell for oil and gas, a real hard sell for public equities. Given we are finding effects here, I'm optimistic this will have bite in oil and gas as banks continue to expand their policies outside of coal and into oil and gas. In particular. Yep.
Are there any other questions that you would like to pose in the Q&A box?
Yeah, I can answer.
Yes, I see there's one more.
Yeah. Okay, so there's one in the general chat about how efficient optimal is this in comparison to other policies, carbon taxes or increasing borrowing costs. So I think carbon taxes are definitely more efficient and optimal. Kind of the normal kind of way I would think about this is if we have an externality, one of the roles of government is to use its taxation power to help internalize the externality. And that leads to like a benchmark notion of efficiency that kind of that internalizes externalities. So that would be the most efficient. I think if we're able to get there, we should not be wasting our time with financial policies. I think we should just focus on kind of carbon taxes or other things that are going to directly internalize externalities. The motivation for this, I guess, is twofold. One is that even regardless of the argument I just made, people seem to be quite interested in these financial policies. And two, it doesn't really seem like governments are stepping up fast enough. So there is interest on the private side of kind of lobbying banks to get out of doing harmful things, of trying to modify your own portfolio, which is an area some of my other research is in how, if you care about the world, can you make a difference with your portfolio? I wouldn't bother wasting my time with that if government and taxation had already internalized all externalities. Let's see. We have a couple more questions. Who is financing the increased coal use in Asia? So that I don't have an exact answer to, but I can tell you in the data, there are a lot of kind of state-owned Chinese banks that are big in the coal market. There's been a big increase in underwriting of coal bonds from Asia into the global bond market. I'm not quite sure yet exactly if that's an actual increase or just an increase in coverage in our data. That's something I'm trying to look into. But if it's not an increase in coverage, it would be international bond investors financing coal in Asia and kind of local state-owned and development banks. Okay. How much are these policies leading to reduction in coal production? That's a great question. And are there concerns that if policies are mostly impacting smaller firms, production will increase acquisitions by larger firms? Yeah, Jesse, that's a fantastic question. I don't have answers on production yet. We tried hard to get data on production and haven't succeeded yet. And also we have some data on emissions. That data is country by country. We aren't finding effects in general in the United States, which is where the data is best. We're finding some effects in Europe where the data is the next best. So we're still trying to put this all together. But then I agree that like kind of a logical extension of the argument of limiting access to capital is that you will turn to another provider of capital. And one of those could be just being acquired by a company with better access to capital itself. So like I said, the big question is the aggregate impacts of these policies, and we're only able to answer in this paper at the firm level. I will say that we looked into M&A activity in the US of coal emitting firms, and we didn't seem to see a pickup in M&A, despite kind of popular narrative articles talking about how all the oil and gas and coal companies are being privately bought up by private equity. I haven't seen direct evidence of that in the data yet. Let's see, one more question so far. Follow up on the question on bank lending and underwriting versus investors and equity holdings. The term divestment is used to reflect the latter. I see. Okay, so this is a question about kind of the definition of the word divestment policy. Yeah, I think this is a good question to ask. I'm open to other words besides divestment. This was just a kind of a choice my co-author and I made. Welcome to have that discussion if there's other words for this. I think kind of banks are divesting in the sense that they're no longer investing, but if you have other suggestions, I'm very open to that to avoid confusion here. Another question, what incentives do these lenders have to participate in divestment beyond reputation? What are the gains and benefits? Okay, so I talked to a large bank, the former CEO of a large bank that's in this sample that has a divestment policy. And they gave the answer that it was a reputation answer, that they said, we're a large, well-diversified international bank. If we drop any of our industries, any one of them, it's not going to affect our profitability. Coal, oil, wood chips, whatever. I mean, anything, they said. That's what he said. It doesn't matter. We picked this one because we're facing pressure from our shareholders, from our employees to get out of bad businesses. So that's the answer for a large bank. And I think that argument holds less true when you get to smaller regional banks that are not publicly traded, that have kind of a big impact on their bottom line here. So yeah, that's my sense, is that the banks are maybe choosing to do this in one sense because coal is a dying industry and it's like becoming less profitable to be in coal. So if you're a large bank where it doesn't affect you, it's not a big business cost to do it. That doesn't mean it's not a cost to your borrowers, right? Like the key thing here is the bank doesn't care if you're not able to find a new borrower, but you actually care quite a bit. So that's why we think the results in this paper might have some bite, even though we can kind of predict which lenders are getting into divestment. That doesn't mean we can predict it from the borrower side. And that's what would matter for kind of a reverse causality story here. How do the results differ for bank lending versus underwriting? So that's a great question. I think the results are very similar, actually. It's basically more about if the firms if the banks the coal company is doing business with have adopted coal policies, than about which form of finance that relationship exists with. And that makes sense to me because if you read the divestment policy documents, they are specifically mentioning that they are not going to engage in underwriting or lending. Most of the time they say that. So it makes sense to me that we really didn't find a measurable or big difference if we looked at it for loans versus bonds. And then it was also an issue of power, right? So by adding the loans and bonds together, we are much more powered in this already pretty underpowered exercise. Can I clarify how you infer that overall debt reduction? Oh, sorry. When I was looking at balance sheets, I was looking at coal firm balance sheets. So the coal firms' balance sheets were contracting, which means even though I wasn't observing individual potential loan transactions for those firms, I could see that the stock of their debt was going down if they were more exposed to banks that were banning coal borrowing. One more question. How would one determine the impacts of these policies on the cost of capital? Yes, so we've looked at that, and it's all kind of noise at the moment. We haven't seen any positive or negative effect that's measurable. We're not powered in our exercise to see the change in the cost of the coal lending that firms are getting. To me, that suggests, and again, that's kind of combined with the fact that all of our effects are coming from the extensive margin, which is that we're just more exposed firms are less likely to raise capital in a given year than less exposed firms. If we were observing that firms are raising less capital, and we might also see that they're raising it at more expensive terms. So to me, this is more about rationing, and it is an important question to see kind of what's the effect on cost of capital. The whole mechanism is that if the cost of capital becomes higher, then firms are not going to kind of undertake things that would have otherwise been NPV positive. So we're not able to say anything on that. Okay, from Jesse, how are you controlling for firms not paying down debt? I can't. So the question is, do we know that firms are not just more profitable and paying down debt? That's a good point. So looking at this total amount of debt on a firm's balance sheet going down, it could be possible that the firms that were more exposed to bank divestment policies were potentially more profitable. That would be consistent with the reverse causality relationship, that the banks are choosing to adopt coal policies if they happen to be lending to less profitable coal firms. That's something we should check, but you're right that it could be coming from something else.
Great. Are there any final questions?
Oops.
So it seems that we've come to the end of the list of questions. I would like to thank Professor Daniel Green for his very insightful presentation today. Thank you all to the audience for joining. We are looking forward to more webinars in the Young Scholars series, and the next webinar will be held on June 19th, where Shanji from New York University will present her paper on the cost of hedging disaster risk and home prices in the face of climate change. More details on this event will be posted on the e-Access Forum website and on the LinkedIn and Twitter page. So thank you once again to Daniel, and we look forward to seeing you next time.
Great. Thanks, everyone.
Bye.